Goldman Sachs chief economist Jan Hatzius. Was there more good news in this report or bad news, or kind of neutral? What do you think?
I thought it was certainly not a strong report. If you look at the employment numbers, that's true for the latest 50,000, a little bit less than expected, and the downward revisions. So if you look at the last 6 months, we've created like 15,000 jobs per month. That's obviously quite weak. And that probably will be revised down because the benchmark revisions are likely to take another chunk out of that. On the other hand, the unemployment rate news was better.
Yeah.
Not only a drop on the month, but also a downward revision. So the increase in the unemployment rate that we've seen over the last 6 to 12 months looks somewhat less concerning now. And I think if I'm the Federal Reserve, that's probably what I'm going to be more focused on, really the balance between demand and supply, especially given the uncertainty around the break-even rate of payroll growth.
Well, the other thing they're going to be talking about, which sort of all investors and economists are scratching their heads over, is this boom we're seeing in the economy and in productivity, and it's not really leading to a boom in job creation. And I guess the question is why? Is it AI? Is it that we're at full employment? Is it that labor supply is just way down because of immigration policies? What's the reason?
I'd say a couple things. One, there is quite a lot of uncertainty about how quickly GDP is actually growing. We still don't have a lot of the monthly source data. We've had a lot of noise in the GDP numbers because of tariff front loading, because of the shutdown. So I would withhold judgment a little bit on just how much GDP growth we're seeing. What is clear, though, is that we've seen an acceleration in productivity growth over the last 5 years relative to the 10, 15 years before that. And that, of course, means the speed limit for the economy is different from what it was. In the near term, I would put more weight, especially from the Fed's perspective, on the job market numbers. We're now actually sort of caught up in terms of having a full slate of information. As far as the jobs numbers are concerned, the shutdown's in the rearview mirror. We have the information, but that's not yet true for GDP.
What's your stance on CPI?
Well, I think in 2026 as a whole, I'm in the disinflationary camp because the sideways move in core inflation that we had in 2025 was related to tariff pass-through. We're estimating about 50 basis points of contribution. So you need to take that out of the underlying rate. So the underlying rate was still coming down. Wage growth is still trending down. Rent inflation is still trending down. So I think by the end of the year, when the tariff impact will have sort of cycled through the year-on-year comparisons to a significant degree, I think we'll be not too far from the 2% target.
Are we by year end?
By year end, we're at 2.1, 2.2%.
2.1. Are we through the fattest part of the tariff pass-through?
I think best guess, and of course a lot of that is going to depend on what happens to tariffs, when we get a Supreme Court decision, what will be replaced, etc. But under our baseline assumptions, we're through 50 basis points and have another 30 or 40 basis points to go.